Welcome, everybody, to today's presentation with LeaseQuery and RGP. You will be seeing our presentation on ASC 842, Navigating the Landmines. So we will be talking about some of the complexities that are involved in actually adopting the accounting standard, and not just the calculations themselves, right? There are a variety of activities, organizations need to go through in the process stage and the planning stage to actually appropriately adopt the new standard. So we can go ahead and jump in. My name is Jason Parker, and I'll be joined by Timothy Tickle from RGP, and we'll do some more introductions in just a minute here. In terms of CPE, so we'll get a little bit of housekeeping out of the way to start. So there is a questions pane within the GoToWebinar panel. You can utilize that questions box right now to simply let us know that you can hear me and that my voice is clear. In addition to that, if you have any questions throughout the presentation, please feel free to utilize that questions box. During our polling questions today, we will try to get a handful of those questions answered. If we don't, we will follow up via email subsequent to the webinar to ensure that we answer any of those questions for you. Now, we have actually attached the presentation as well in the handout section. So if you would like to download the presentation for your own sake, feel free to do that within that handout section. Now, in regards to CPE, so there are two criteria in which you will need to complete in order to qualify. So one, we will be launching polling questions. You'll need to respond to at least 3 of the 4 questions that we launched throughout the broadcast. In addition to that, you'll need to be logged on for 50 of the 60 minutes that we are launched for presentation today. So just as a reminder, there's 2 steps here. One, answer at least 3 of the 4 polling questions and be present on the broadcast for at least 50 of the 60 minutes that we're broadcasting. If you do meet those qualifications, we will email you a certificate within the next few business days. I always recommend giving us at least 1 week in order to get you those CPE certificates. If you don't see one come through within the next week, please feel free to reach out to us. You can see our CPE specific email address down at the bottom. So if you have any questions just in regards to your certificate or anything else related to the CPE process, please email us down there at the bottom at cpeinfo@leasequery.com. Now, for a little bit of background on LeaseQuery as an organization. So LeaseQuery offers a lease accounting SaaS solution for compliance amongst multiple jurisdictions. So we offer accounting compliance for ASC 840 and ASC 842 under the FASB jurisdiction. That is what we will focus on in today's presentation. We do also offer compliance for the international accounting standard, IFRS 16, as well as GASB 87 for state and local governments. And you can see on the right side, LeaseQuery has around 1,300 to 1,350 customers today. We have presence in 87 different countries around the world. And we do have a large number of public organizations that adopted 842 in 2019, as well as private companies that either utilize our tool for the 840 accounting guidance or have adopted the standard early. And you can see we've had success in the space with a 99% retention rate for all of our current clients up for renewal. And one of the reasons we've had so much success is the why behind LeaseQuery. We were purpose-built for accounting compliance rather than the vice versa, serving as a lease management tool that built on an accounting module. The design of our system is built specifically for 842 compliance, as well as a more efficient and streamlined audit process as well. So with that, again, more of a formal introduction from myself. Again, my name is Jason Parker. I'm an accounting solutions manager at LeaseQuery, so I perform a handful of roles. I do have a background in external audit from KPMG, so I came over to LeaseQuery to not only help them build the LeaseQuery product, from a technical perspective, but also to present to external parties to understand more about 842 guidelines, as well as how our product can provide compliance. But again, with me, I have Timothy Tickle, who is VP over at RGP, and I will pass the microphone over to Tim to give a little bit more background on himself as well as RGP.
Thanks, Jason, and good afternoon, everybody. Thanks for taking the time to join Jason and I in this discussion today around ASC 842. As Jason alluded to, my name is Timothy Tickle. I'm a vice president with RGP within the finance and transformation space, focusing very heavily for the last 4 years in lease accounting across all the jurisdictions, as Jason alluded to. My background, about 15 years in public accounting, and then spent about 15 years as a corporate executive for a Fortune 100 global manufacturer. About RGP, we are a professional services consulting company. We have approximately 4,000 consultants worldwide and operate in a number of countries and have offices in over 35 countries worldwide. We do retain a lot of our work from our Fortune 100 clients, but we also spend a lot of time serving the mid-market as well as the smaller entities in achieving compliance with the lease accounting standards. And so for the focus of the discussion today, what I'd like to do is kind of at least present overall a general adoption methodology that will kind of guide us through the discussion today. And when we're looking at ASC 842, I think a lot of organizations identify the accounting change that's associated with it. But in connection with the actual adoption, there's a number of additional ancillary work streams that are critical in making sure that you formally adopt the standard and apply all of the appropriate rigor associated with that, but also more importantly, you're in a position to sustain compliance over time. And so with that, we basically divide the adoption methodology into 4 distinct categories of work. One, the assessment and policy, and that is, we'll talk about that more, but this is where you're assessing the completeness of your lease portfolio and performing activities to ensure that you have enough documentation in place to sustain an argument to your external auditors that you have captured everything within your portfolio. It also addresses a number of the policy and practical expedients that are afforded along with the adoption. And we'll talk about that more as we kind of move through the landmine discussion today. Additionally, there's a significant component of work that I deem to be process transformation. But again, this is kind of focusing more importantly on the day 2 function. And for day 2, I define that as every day after the adoption, and making sure that the organization has well thought out processes and controls to ensure that after you have adopted the standard and you've deployed a lease accounting solution, that you have processes and controls in place to ensure that that stays accurate and complete over time. And so that process transformation phase, we'll talk about the challenges that typically face many organizations as they look towards defining that day 2 process. We also identify a clear component of the adoption methodology around data collection. And, for the sake of just comparison, data collection is probably the most time-consuming component of the adoption process. And so we'll talk about briefly the challenges and the hurdles that you are likely to encounter as you move through data collection. And then lastly, we have the technology strategy. And this is ultimately the deployment of an accounting tool like LeaseQuery to manage your accounting going forward. And what are the challenges and anticipated hurdles that you'll have as you look towards deploying that technology strategy. We will also talk about just overall project governance, and we'll kind of begin there when we kind of dive into the actual landmine discussion. And so I think we'll start the discussion with general, the landmines that you're most likely to encounter as you move through the overall project. And I think critical to a successful adoption, we have found that organizations that develop a plan, stick to it, and are agile enough to, reassess and pivot accordingly, are the most successful organizations in doing the actual adoption. And the reason being is there is a significant amount of activities that are usually being performed at the same time. So if you think back of that overall adoption methodology, there's typically components of all 4 work streams occurring at one given time. And understanding that, that's 4 different and distinct work streams that have a significant amount of interdependency upon them, we suggest the use of a comprehensive project plan to manage this, to align all of the interdependent activities and deliverables to make sure overall that your project stays on task. We would anticipate typically that, an overall project would take anywhere from 3 to 4 months to get through all of the associated methodology. But if we fail to plan and fail to capture all of the activities and manage that through a formal project management governance, we typically can see those project plans ballooning to 6 months, 8 months, even a year, when those interdependencies and those work streams are not fully captured and identified and managed. So I think from an overall project perspective, the main, hurdle or challenge to overcome is to make sure that you have resources aligned to manage that project plan, and that those resources are not assigned to other areas of the project. So we typically saw early on with the public entities that perhaps maybe an organization would assign someone within finance and accounting to be also the quote unquote project manager. That works well for a period of time, but when we get into the heat of the battle and when we have all of the work streams, activities occurring at once, there's typically too much for that particular person to do their anticipated project-related activities, but also manage the project. So we would suggest that you leverage full-time project managers to provide that overall structure and guidance to manage the deliverables and the overall timetables of the project. Jason, I don't know if you have anything that you'd like to kind of chime in on here as it relates to overall project management.
Yeah, no, I honestly, I think you covered it pretty significantly. I think the one very high level concept I always like to point out to people is if you just take a look at the multiple steps that you've laid out here, this indicates why organizations like an RGP and even a LeaseQuery would suggest that the earlier that organizations can begin the process of adopting this new standard, the better, because it's not just as simple as, hey, we need to perform a calculation for present value. It's understanding individuals at the organization that'll be responsible for building out new processes, new controls, evaluating technology, all of this stuff that's listed here. These things take time and resources. And so that's why the earlier that an organization can get started, the better. So
that's a good point. Thank you, Jason.
Yeah.
We'll next move into, go ahead, Jason. I'm sorry.
No, that's my fault. Yeah, so you go ahead.
All right, so I was just going to kind of dive into the next kind of main area. We just talked about overall project governance. Let's talk now as it relates to specifically the assessment and policy. I think, some of the items just to keep in mind as you're moving through this, and again, these things are born from experience with the public companies and the challenges that we faced as we assisted them in their journey. But I think overall what we would say is make sure from a policy perspective that you make your decisions carefully. And the reason being is that, some of the decisions and the practical expedients that are afforded are pretty straightforward and make pretty easy sense. But when in reality, you actually have to operationalize a lot of these policy decisions. So when you think about materiality, that is something that, there's a number of different ways to look at and define materiality in the construct of leasing. And so not only is it, understanding what is going to be the materiality for your particular organization, you have to think about operationalizing that. So ultimately, who's going to be applying that materiality, and do they understand the intricacies that are required in coming up with the actual calculation to determine whether a particular transaction is in scope, and is that documented in a formal policy and disseminated to the organization so that they ultimately know. Additionally, there's some other types of elections that you definitely want to assess not only whether or not you want to elect them, but also you want to delve into the operational aspect of it. So when we think about short-term leases and whether or not an organization is going to exclude those, I think that's a pretty straightforward election. Items less than 12 months, do I want to include them? If an organization decides no, they don't want to include those, then they need to operationalize that. Okay, as an organization, who's going to be making that decision? Who's going to evaluate the contract to ensure that, if there are cancelable terms, that those have been considered in the determination of the actual lease term, etc. Other practical expedients, such as separation of lease and non-lease components, those have a significant operational impact that, when in reality, go far beyond just the actual election themselves, and they actually go into that kind of day two component where, how am I going to make sure that the organization is capturing this information correctly? How do I make sure that, I'm getting visibility to all of the potential embedded lease contracts of the organization so that I can apply these policies and these expedients appropriately. Lastly, I think the software implementation decisions, I think early on, understanding whether or not you're going to include integrations and what are those types of integrations. We see typically GL integrations, AP integrations that can include master data, payment data, COA integrations. Understanding the impact of all of those will also have an important role in determining your day two process. So making sure that you take the time early on to appropriately choose the right policy decisions, and then ultimately get all of those memorialized into a formal policy. Those will go a long way towards, educating the user base on, what are the new policies, how are they going to be administered, who's responsible for administering those, and ultimately provide a lot of answers to those questions the organization may have. There's some additional areas that I think Jason would like to talk about at this point.
Yes, thank you, Tim. Yeah, and this just segues nicely from the previous slide. So in terms of practical expedients, we wanted to cover a couple of them for the audience today. The package of practical expedients is likely the most common one that organizations do here. Now, you'll notice at the bottom, these three expedients do all have to be elected together for the entire organization. So you can't pick and choose either at the lease level, the entity level. You will have to elect all three of these together, and we'll walk through the complications surrounding that. So the first on the left is reevaluation of lease identification. So of course, the definition of a lease under the ASC 840 guidelines is a little bit different from the definition under ASC 842. And rather than just go into the nitty-picky details of that definition, the purpose of the expedient, if you have appropriately designated whether an asset qualifies as a lease under 840, you do not have to reevaluate existing contracts when you reach the transition deadline as to whether they qualify under the 842 definition. So it makes the adoption process a little bit easier. But one caveat here is that you do need to have evaluated your leased assets appropriately under that 840 standard. And that sounds maybe a little bit more intuitive than it maybe was for some organizations just one example, the embedded lease analysis. Tim talked about this a little bit earlier, and we will show the embedded lease decision tree here in a slide or two. However, the problem organizations are running into these days is that on a service contract, for example, if you had an asset that may or may not qualify as a lease, under the 840 guidance, there wasn't really any financial statement impact whether you determined it was a lease or not, right? You would either have it as an operating expense from the contract, or you would recognize the lease expense. Either way, no balance sheet impact and a very immaterial income statement impact, just depending on whether you straight lined the expense related to the lease accounting. So point being is that there may be some contracts that you need to go through and evaluate under the 840 definition to ensure that you did qualify those as leases if you want to elect this practical expedient. So that's step one, is just, hey, as long as we have identified all of our leases under the 840 definition, we don't have to reevaluate any leases or any assets we didn't qualify as a lease to see if they meet that 842 definition. Now, the second one is really the same thing, but with a lease classification. So that would be the operating versus capital designation. So two specific changes to that criteria as you move into 842. 842 does not require organizations to calculate 75% of the lease term versus the useful life and 90% of the fair value. You can determine your own thresholds, even though they do suggest using 75% and 90%. Additionally to that, the US GAAP has added a fifth test to determine whether an asset is so specialized that it has no value after the lease term. So both of those would qualify as a finance or capital lease under the new standard. So point being is that if you have appropriately evaluated whether a lease is operating or capital under 840, you do not have to reevaluate existing leases under the new classification guidelines. That would only be for new leases that you enter into from the transition date on. So again, it's helpful with all of your existing information, transitioning that to 842. The third piece of this is another item that you would not have to reassess, which would be initial direct costs. Initial direct costs, if they do qualify, are capitalized and straight lined over the term of the lease agreement. Now, the definition and scope of an initial direct cost as we move into 842 narrows a bit. So there are less costs that can be capitalized and evenly expensed. So point being is that if you have appropriately determined that a cost qualifies as an initial direct cost under 840, you do not have to then reevaluate whether you need to expense the entire amount when you reach the transition to 842. So really all three of these combined are taking existing contractual terms, and as long as you accounted for them appropriately under 840, you can avoid having to reevaluate everything when you reach the transition period. So again, the simple thing is, if you've done things correctly under 840, you should be good to go to elect the practical expedient here. If you haven't, that may cause a little bit of extra time on your hands to make sure that you've done everything correctly. And so with that embedded lease analysis, this is more so for determining whether you have a lease. This is not only designed to ensure that you accounted for leases appropriately under 840, but ensuring that you have a full lease population as you move in to 842 accounting. So you can see all of the steps on the right. You have to identify an implicit or explicit asset within the contract. You have to ensure that the vendor or landlord cannot actually substitute that asset for another one without your discretion. And then, do you have the ability to direct the use of that asset and derive substantially all of the benefits? And again, we're not going to get into the nitty-gritty details of walking through the embedded lease analysis today. What we want to point out is for all of these implicitly or explicitly identified assets within your contracts, you would need to walk through these steps to ensure that you have appropriately documented whether an asset qualifies as a lease or not. So again, all of this is just one step of the process of adoption. It's going to take a little bit of time. LeaseQuery does offer a free tool on our website that can walk you through some of these questions to help assist. And I know Tim's team also helps organizations walk through this information as well. So there are resources out there to assist organizations to speed up the process. Now, another practical expedient that we did want to talk about was the combining of the lease and non-lease components. And there's also pros and cons to electing this expedient, right? It's not just, hey, we should always elect the expedient. We'll talk about those in just a second. But under 840, if you have any non-lease components, such as common area maintenance costs, tax reimbursements, those are considered executory costs in the lease contract. And so every payment you make for a lease under 840, you would have to allocate a specific component of each payment to the lease component and the non-lease component. So there are some allocation calculations that are necessary that provide a little bit of an enhanced complication to accounting for the lease. So what the boards have offered under 842 is the ability to just combine the lease and non-lease components into just one general lease component in the contract. Now, it's not as simple as just capitalizing everything, right? The next step is to determine, well, of these components, what are my fixed components and what are my variable components? So if you do elect the expedient, what you would do is any fixed component within the contract, you would capitalize those amounts together as one amount at that same present value calculation, and that would be your lease liability balance. And then any variable payments that you make, you would expense those amounts in the period in which the expense was incurred. So what it does if you elect the expedient is it simplifies how you allocate those costs. You don't have to take each payment and allocate a portion to the lease component, a portion to the non-lease component. Really all you're doing is saying fixed payment, capitalize, variable payment, expenses incurred. Makes that process a little simpler, but we will also point out the downside of electing this expedient, as we'll see on the next slide, is that your liability may end up being higher, right? So more costs that are fixed, the more dollars that you would actually present value to calculate your lease liability. And in addition to that, we mentioned the capital versus finance the finance/capital versus operating lease test does involve a comparison between the present value calculation and the fair value of the asset. So if the present value calculation is higher, that could potentially impact whether a lease qualifies as a finance lease or an operating lease under 842. So that's another aspect of this that an organization may want to consider before just simply electing the expedient. In practice, we see vast majority of organizations electing the expedient as the ease from not having to perform the allocations typically outweighs the downside of having a little bit higher liability balance. But again, it's not a catch-all. There's certain things to evaluate from this perspective. But with that, Tim, I wanted to pose to you if you wanted to add any details regarding some of these expedients that you've seen in practice, and then from that point we can jump into the first polling question.
I think the only thing that I would add to that, Jason, is that, some of these elections do afford you the opportunity to make different elections based upon the class of asset. So the lease and non-lease component is a good example where, for certain real estate contracts, it may make sense to combine the lease and non-lease component to make that easier to administer or to separate. Maybe you want to separate those executory costs and make sure that those are, kind of managed separately to your lease expense. Whereas maybe on your office equipment portfolio, your copier lease that has a component of repair and maintenance in the contract, maybe it makes sense on that for the office equipment to elect to combine them. So there is an operational component to these elections that, you may want to consider, making sure that you have a good understanding of what makes sense operationally to determine, the appropriate election. Some organizations maybe, for simplicity, they code all of their real estate payments, regardless of whether it's CAM or insurance, to lease expense. And so in that case, it may make sense to combine them because that's how it's traditionally been reported on the financial statements versus, maybe an organization is separating out their CAM and their insurance and their operating expenses into separate expense accounts. And so that would, probably more align towards the election to separate the two and in order to kind of keep the financial statement presentation more consistent with how you've done things in the past. So it's more than, we definitely don't want to make these elections in a vacuum. We want to look at operationally how it will impact the way that we've reported in the past, as well as how we'll report going forward in making the appropriate election. Maybe we'll now transition into our first polling question. First polling question: in the next 12 months, will the number of leases the company manages, and I think that there's a number of different options to select from. Is that poll being broadcast? I'm sorry, I don't see that.
Hi, Tim. Yes, we put the poll up and we're getting some responses. Just about a third of folks have voted, so we'll wait a couple more seconds to see if everyone wants to. And I'll close this poll down. So please get your final answers in. 3, 2, 1. And here's the results of what we've seen with our answers today. Looks like most folks are saying their leases are going to stay about the same over the next year.
Great. So now we'll move into the next major area of the adoption methodology and kind of talk about some of the challenges that we traditionally see in this space. So within the space of process transformation, again, this is the component of the adoption where we're looking beyond the adoption date, and we're trying to determine what changes need to be made in our current operating environment for procurement of, say, equipment leases or our procurement of real estate leases, as well as just general contracting as it relates to embedded leases, will need to be made to ensure that, whenever a new lease is entered into, or a lease is modified, or a lease is terminated, or perhaps even an embedded lease is entered into, an embedded contract per se, that we have the appropriate processes in place to ensure that finance and accounting is notified when necessary to make the requisite changes in the lease accounting platform. And so the one thing that we definitely want to encourage and recommend is make sure that you gather the right stakeholders. Typically, as I mentioned, there's a number of different organizations that are either impacted or play a role in the current procurement process. Now, obviously, procurement and sourcing are two of the main areas, but we traditionally see that perhaps you have IT or real estate or perhaps even legal impacted by, changes going forward that will need to be adopted by the organization to ensure that we have the appropriate processes in place. So our recommendation is making sure that you have those right stakeholders, and then once you've identified all the appropriate stakeholders, bring them all together to help define what that role and that process is going to be going forward, as opposed to kind of creating that in a vacuum, say within accounting and finance. Those organizations having a seat at the table will help define, when, and what will change within their organization to meet the requirements of the day 2 process. And they also will, ultimately be responsible for promulgating or pushing that change out through their organization. So, making sure that you have, defined what that future state process is going to look like, then document it and make sure that all of the roles and responsibilities are clearly defined And then lastly, kind of memorializing or providing that overall governance structure through the form of a formal accounting policy that will outline and define a lot of the components of the process, so that that these are memorialized in a going forward. So that policy and that process documentation ultimately becomes the basis of change communication to the organization. So ahead of the adoption, we would be pushing out the process flows and the process requirements and roles and responsibilities along with that new accounting policy, so that the organization knows that once we adopt this standard, my role and responsibility will change. And then when certain things occur, I now have a different process, or at least a notification process to get to involve accounting and finance to make sure that they are aware of the changes and that they have the appropriate information to update the accounting platform accordingly. Depending on the organization, it could be as simple as just accounting and finance and maybe procurement, but we have, worked with certain organizations that have, all of the structures or stakeholders that are identified on the screen here that are potentially involved in that day two process, discovery and documentation process. I think, some of the additional things to think as you're working through that day two process is to clearly define those process roles and responsibilities and who owns them. More importantly, when we're getting outside of accounting and finance, making sure that we have clearly defined what those organizations are responsible for. So in the context of a new lease, within procurement, what are they required to send to finance and accounting to make sure that gets updated in the system? Is it just the contract, or is it, the payment structure? Clearly defining everything that needs to be communicated to accounting and finance to update the accounting platform. Additionally, making sure that you have adequate controls in place. So, once you've defined that day two process, you should be performing a control evaluation to make sure that any new risks that are posed with the new process are appropriately controlled. Examples of controls would be potentially, reviewing GL outputs for certain expense accounts to determine whether or not we missed any leases during the month, and adding some additional controls to ensure that, if we have to gather information for disclosures, et cetera, that we've adequately defined what those controls are, and that we know exactly who's performing those and what the evidential requirements are for that. Now, additionally, as part of this day two, we see a lot of organizations that potentially in the past maybe haven't incorporated a lot of the formal procurement strategy or governance that maybe they wanted to as an organization. So this is an excellent opportunity for your organization to consider adding some additional structure to your procurement process, such as introducing a lease versus buy strategy. Typically in the past, organizations maybe have steered clear of this because there is maybe a mandate that everything has to be leased or purchased, depending on the organization. Either to make sure that all of the expenses hit the P&L, et cetera, versus capturing that as a capital lease. Now, with all of that going away with the new accounting standard and the fact that everything is now being put on the balance sheet, maybe an organization wants to really, look at the economics behind the actual asset acquisition to determine, appropriate lease versus buy conclusions. Additionally, potentially adding some automation down the road. So if you choose as an organization maybe not to fully integrate your accounting platform on day one, maybe down the road as a phase two component of the project, you want to introduce some of that full integration to automate some of the processes that maybe you're doing manually up front. And then lastly, there is a component of this that, many organizations may not have the bandwidth to fully source an administration role after the go live. And so they may be looking for a business partner to actually perform some of that ongoing lease administration in their platform. That is something that is coming more prevalent in market today, as we see a lot of the public companies are looking to reassign or outsource a lot of that activity just due to the time and expense it takes to maintain that part of your organization. Jason, anything to add from your perspective as it relates to process transformation?
Honestly, I think you covered it. I really don't have anything else specific to add from that perspective. I think just to move the conversation along, we can jump into one of those processes, which is identifying the discount rates that an organization will need to utilize for their lease portfolio. This is a little bit more on the technical accounting side, but it is another aspect of this that organizations have to go through. So what we've done here is just quickly pulled together a summary. So we've got public companies on the left, private on the right. You'll notice the one key difference is that private companies do have the ability to utilize a risk-free rate to ease the adoption and the identification of what those rates are. So what we want to do is just quickly go over what that risk-free rate means, how to apply it, and in addition to that, the impact. So a couple things to think about. So the risk-free rate is typically seen as the US Treasury rate for a T-bill. And what the boards have stated actually just as recently as a couple weeks ago. So typically, this rate would have to be applied at the organizational level, but now the boards are potentially offering organizations the ability to take this rate at the asset class level, just depending on whether you wanted to utilize a normal incremental borrowing rate for some of your longer term real estate leases, but maybe use the risk-free rate for some of those more high volume, low dollar value equipment leases. So with that being said, if you do want to utilize the risk-free rate, two things to think about. One, if you are in plans to go public at any point, or if you do believe you might get acquired by a public company, you would have to restate retrospectively back to the beginning of the transition utilizing a normal incremental borrowing rate. So if you do have plans to go public at any point, if it's possible, we would probably not suggest going with the risk-free rate election. The second piece of this too is, again, similar to that practical expedient we talked about, combining the lease and non-lease components. The lower the rate that you utilize, obviously the higher the present value on your balance sheet. So you would have a little bit more of a higher liability value using that risk-free rate. So just assessing how that might affect debt ratios, something to consider there. But what we've done here is attached the guidance where it does state that an organization can use the risk-free rate. You should use the rate implicit in the lease. However, most lessees do not have the information necessary in order to calculate that implicit rate. Then it would be suggested to go to your incremental borrowing rate, which is typically obtained from a financial institution based on the rate you would obtain from a collateralized loan. But again, you can see below that for non-public business entities, those organizations can utilize a risk-free discount rate based off of a period that is comparable with that of the lease term. So that's the gist from a borrowing rate perspective, keeping it high level. And then from a summary perspective, here's what we just went over, right? Risk-free rate, zero coupon US Treasury is going to be utilized both initial and subsequent measurement. And if the election is made, previously it would be applied to all leases, but the boards are moving towards allowing organizations to elect that at the asset class level. And another thing to think about too, sometimes under international accounting, we've seen some negative discount rates, but under US GAAP, if you do elect the risk-free rate, that rate cannot go below zero. So with that, we can go ahead and launch that second polling question here to get a little bit more information on the impact of lease accounting previously.
And we will close this poll question down in 3, 2, 1. A quick share of the results shows where folks are, and I'll hide this.
All right, Tim, and we can pass it back over to you for navigating the landmines here, and so you can go ahead and jump in talking about the data collection.
Okay, will do. Thanks, Jason. So I think when we talk about data collection and the landmines that are associated with the adoption process, I would probably consider that there are more landmines in the data collection process than any other component of the adoption methodology. And I think the challenges, as we've kind of laid out here on the screen, is, obviously we talk about completeness, and that's something that has to be maintained throughout the life of your adoption. So when we think about, you perform your assessment as of a certain time, but then between that assessment and then the ultimate adoption time of the standard, your data is going to be changing. So when you're thinking about managing the gathering of data associated with the deployment of a new accounting platform, it is a lot like nailing Jello, in that it's always changing, and it's very, you have to develop a process to not only capture the initial data that you've maybe assessed during your assessment phase, but also capturing all the incremental data that is currently and always changing throughout the implementation process. Some other things to consider, we talk about scoping and materiality. A lot of organizations maybe begin the adoption process with trying to go out and gather all their leases. Well, I think the one downfall in that activity is the fact that you may be gathering information you don't need. So we do encourage most organizations to undertake as much of the assessment and the scoping process as possible, because at that point, then you'll be able to identify exactly what data you do need. And so, making sure that you spend the time to do that, you'll actually save time in the long run, and in making sure that you're getting the data that you actually ultimately need to deploy the system. Other areas to consider is accuracy. When we talk about completeness, the other financial statement assertion that is extremely important in this phase is accuracy. And so what that means is not only do we have to capture the documents, identify all the contracts, but then we have to go in and pull specific data elements out of all of those contracts and load them to this new lease accounting platform. Prior to loading anything in the platform, your external auditors will expect that you've done some type of secondary accuracy check or validation of the data. And so keeping that in mind, that will be an iterative process that you have to go through prior to even ingesting any of that data into the system is important to understand, as this will take a significant amount of time. Additionally, when we think about additional challenges, making sure that, what we're capturing is actually a lease. So, when we think about that scoping process and the embedded lease process that Jason walked through, you wouldn't ultimately want to, begin data collection until you have completed some of that work. Again, making sure that you're not gathering more data than you ultimately need. And that last piece there, external audit requirements, understanding that, as with any system implementation, you're going to have to validate data before it goes into it, and you're going to have to maintain documentation of that. So, being clear and concise in the way that you capture the data and providing an adequate audit trail to the process will be critical in ensuring that your external auditors can get through and validate what they need to as part of their overall audit requirements. So when we think about the iterative process, I think you can see ultimately where all the time stacks up as it relates to data collection. You've got to, again, identify all of your sources. So where are all the contracts at? are there other data repositories that we can leverage to get existing lease data? Some of that may be housed in spreadsheets internally, but some of that may actually, be provided by a vendor that maybe is managing a significant number of assets under a master service agreement. So leveraging, as much of those existing data sources we can, we then have to get to, determining the requirements. And so this is ultimately going to be where we marry the data that we have to what is ultimately going to be required by the accounting system in order to do the accounting. And that may include only the data fields that are applicable to accounting, but it may also include additional data fields that your organization wants to capture as part of this implementation. So understanding what are the data elements within the platform that you're going to use is critical in kind of identifying what is ultimately going to be abstracted in that third step. So that third step is actually going through either the existing data sources that we have, or even going directly to the contract itself and getting the data elements out of the contracts and populating them into an upload template. This process is very time consuming. I think on average, you can probably expect about an hour to an hour and a half for an equipment lease to abstract all of the data elements and put them into an upload template. On the real estate side, it could be as high as 3 hours for one contract. So when you think about the overall, time consumption of this project, most of your time and critical time is going to be spent in abstracting and filling out the upload templates. And then lastly is the validation component. That is two-phased. One is, validating the data before you upload it, and the second component is reconciling it once it has been loaded into the platform to make sure everything has been uploaded correctly and that it all is in the correct format. So this overall effort, as I mentioned, does produce probably the most challenges to an organization from just a pure time perspective, the fact that this could take hundreds and hundreds of hours, and that the resources that you've aligned internally maybe are not sufficient in order to meet the timetable that your implementation is set on. So understanding this component will go a long way to understanding overall whether or not you have adequate resources to meet the time requirement. And RGP does have on their lease portal, and you can find that on the RGP website, a time calculator where you can plug in your number of equipment leases and real estate leases and get an estimate of the amount of time it will likely take you to perform this step. And I would encourage everyone to kind of go through that exercise, because again, when we think about the overall time commitment and the resources that are available, this is where most of them will be eaten up in the project. Any comments from you, Jason?
No, I mean, I think what you've laid out is important, again, with the abstraction phase from a technological standpoint. When we think about entering information into LeaseQuery, it's understanding the stakeholders that will be involved in this project. How much benefit do you want to get out of a technological tool? Would you like to have lease administration functionality for multiple departments? Are you just looking for 842 compliance? All of that also impacts the level of effort necessary in the abstraction phase, and also understanding what details within a contract that you would need to focus on. So that's really it that I would point out. Obviously we could, go through some more details there, but I think you laid it out well.
Great, thanks. And so with that, we'll push the third polling question, which has to be, outside of the lease accounting, what is the biggest challenge for your finance and accounting department this year? We'll give you some time to answer that.
And we'll go ahead and close this third poll down in 3, 2, 1. To share the results of that, and it looks like process inefficiencies is the first one for folks then working remotely and with a tie with the inadequate infrastructure, understaffed, and the access to capital.
Great, thank you. Okay. So lastly, and I know that we're running up towards the end here, the good news is that when we get to this last part, the system implementation, you know, unlike other system implementations that you as an organization maybe have encountered, this is actually the easiest part of the implementation process or the adoption process, in that the systems that are out there, they are mainly SaaS-based. They have a pretty straightforward implementation strategy. And the way that these are deployed, you know, these have been done hundreds and hundreds of times. So the methodology is pretty tight in how it's delivered to the organization, as well as ultimately how it's, moved into production. But I think, you know, the key thing here that I would recommend everybody as not necessarily a landmine, but more of just a best practice, which is just make sure that you do formal requirements gathering before the selection of the software, making sure that you understand your portfolio and some of the intricacies associated with it, as well as understanding any additional stakeholders beyond just accounting that might benefit from the software and what their requirements may be. Ultimately, this will, get you to the correct software selection and the correct platform that will provide the most benefit to your organization over and above the actual deployment of the software and meeting the accounting requirements. So just taking the time to move through the requirements and speak within your organization will make sure that you choose the right platform and that you ultimately get the benefits that you were anticipating. And so lastly, we'll move to the last polling question as it relates to which has to do with whether or not your organization would like to schedule a demonstration of LeaseQuery, and we'll give everybody some time to answer that question.
Yeah, and just some context here as well. So what you would get with a demonstration of LeaseQuery is you would have one of our accounting consultants walk you through the functionality, so you can utilize the opportunity for a demo as both the ability to view the LeaseQuery product and ask the accounting expert any questions that you would have on the adoption process and some of the technical complexities of 842. And we'll be talking shortly after the polling question completes that we will be offering a $500 off coupon if you do request a demo within the next 5 business days. Your organization would be eligible for $500 off of your initial setup fee. So just something to think about. If your organization knows that eventually you would like a demo, you would get a financial benefit from requesting that demo today.
We'll close this poll in 3, 2, 1.
Great. So Jason, as Jason just alluded to, and he explained the $500 credit that would be provided should you request a demo by May 26th. Again, I think that this is twofold. Not only do you get to see the software itself in operation, but you get an opportunity to actually see what the softwares are providing and perhaps maybe give you more insight into what you can gain from an accounting software platform beyond just the accounting itself. So I would definitely recommend those that haven't seen the platform, an opportunity like this would be good to start your implementation and adoption strategy moving forward. In addition to that, at RGP, we do offer a free virtual workshop, which is about a 90-minute deep dive into your particular lease adoption strategy, where we take you through not only the methodology that we've discussed today, but we also gather information from you to understand specifically what your hurdles and challenges are going to be, as well as help you kind of develop a timeline as well as general project plan to review to make sure that you kind of understand what's ahead of you. Again, this is free of charge. If you do have a desire in having us kind of walk you through that virtual workshop, please contact us at leases@rgp.com, and we'll get that coordinated and we'll set that up. Lastly, at least from RGP's perspective, I'd like to thank you for taking the time to join us today. I know we didn't have time at the end to answer any questions, but I do believe that, you know, if there were any submitted, Jason and I will make a point to specifically address those and reach out to those attendees and make sure that those get answered in the next business day. Jason, I don't know if you want to say any final comments at the end here.
Yeah, no, we sincerely appreciate you joining us, Tim, from RGP and you know, the LeaseQuery partnership with RGP. You know, we feel like as a team, we have a lot to offer from, you know, us providing the technological solution, whereas RGP can provide the project-based solution. I think in tandem, we can provide a great solution for you all. So, you know, please reach out to either myself or Tim for any further information that you'd like. So. But yeah, with that, we appreciate everyone taking the time to join us today. So.
Yeah. Thank you, everyone.